Right now, the financial world is reacting to an absolute shockwave. IBM shares just plummeted, wiping out literally billions in market value in a matter of hours. Why? A severe warning that their second quarter earnings fell way short of expectations. Welcome to The Explainer. Today we're cutting through all the noise and looking strictly at the hard data. We're going to break down the 7 key facts that every investor absolutely must know about this sudden, historic drop.
So this brings us to the ultimate high-stakes question on Wall Street right now. Is this steep plunge a rare golden buying opportunity for value investors? Or is it a blinking red warning sign of much deeper operational issues? Look, when a legacy tech giant, a historical bellwether for enterprise spending, stumbles this publicly, the market demands answers. We really need to know if this is just an isolated IBM problem or an early warning signal for the whole tech sector. We're going to objectively diagnose exactly what happened, step by step, using just the facts on the ground.
Here is how we're going to break it all down today. First, the Q2 earnings shock. Second, hardware shifts and delays. Third, execution and AI growth. And finally, the big question, is IBM a buy right now?
All right, let's dive right into part 1, the Q2 earnings shock.
Financial markets are completely built on predicting the future. First, Q2 expectations were set, and Wall Street had its models locked in. Across the broader market, expectations were remarkably high, right? Other major tech players were posting incredibly strong quarters. But then IBM completely disrupted those models by warning of a significant shortfall. The contrast between Wall Street's optimistic tech models and IBM's reality check was, frankly, jarring. And the reaction? Immediate and brutal. Shares plunged. Markets absolutely hate surprises. And the sequence perfectly illustrates how quickly a missed expectation turns into a violent reaction on the stock chart.
Listen, this wasn't just a minor slip. It was a definitive double miss. Fact number 1, earnings missed expectations, and fact number 2, revenue disappointed Wall Street. Digging into the core metrics, this was really driven by notably weaker software and infrastructure performance. High-margin segments, especially in software and consulting, lag significantly behind projections. Now, when a company misses on the bottom line, earnings, it's an issue of profitability. But when they also miss in the top line, revenue, well, that signals a broader fundamental issue with just bringing cash through the door in the first place.
And that severe double miss leads us directly to fact number 3. Investor confidence weakened, sending shares sharply lower. It's so essential to remember that stock prices aren't just a reflection of past performance. They are a metric of future confidence. When high-growth expectations are shattered, especially when you compare it to the stellar performance of other legacy tech peers, that fundamental trust gets fractured. Wall Street instantly punished this sudden loss of confidence with a sharp, unforgiving sell-off, fundamentally altering the whole psychology around IBM's near-term prospects.
Moving on to part 2, hardware shifts and delays. This brings us to fact number 4, which is a critical discrepancy between what analysts expected and what actually happened on the ground with enterprise clients. Wall Street was banking on broad enterprise spending, heavily weighted toward those lucrative software renewals. But instead, customers actively shifted their spending toward hardware infrastructure. Enterprise clients chose to refresh legacy servers and mainframe hardware rather than commit to new software suites. This pivot in customer behavior essentially meant that capital didn't flow into the higher-margin growth areas that the market was aggressively pricing in.
And to make matters even more complicated, we hit fact number 5. Major deals were delayed. CEO Arvind Krishna specifically pointed to a tough macroeconomic environment and intense client hesitation that caused these massive enterprise agreements to just stall out. In enterprise tech, we're not talking about small transactions here. These are complex, multi-million-dollar agreements that literally dictate quarterly success. So when high-level deal cycles are prolonged and pushed out of the quarter, it acts as a massive drag on revenue. The capital is still out there, sure, but client caution just kept it from crossing the finish line.
So what you have here is basically a perfect storm. You've got shifting customer priorities moving heavily toward lower-margin hardware, and you combine that with unpredictable deal timelines, causing major, highly anticipated software and consulting agreements to stall out. Together, these two operational realities created a compounded, unavoidable hit to IBM's Q2 performance. It wasn't just one macroeconomic factor going wrong, it was like the intense friction of multiple strategic gears grinding at the exact same time.
That takes us to part 3, execution and AI growth.
Fact number 6 comes directly from CEO Arvind Krishna, who stated a renewed focus on, quote, improving execution. Now, in corporate leadership terminology, this is a direct, internal acknowledgement that severe operational missteps happened, and they absolutely must be fixed swiftly. This means heavily reorganizing sales teams, drastically cutting unnecessary costs, and tightening up those sales cycles to finally close the delayed deals. It's essentially a pledge to Wall Street that IBM is going to fundamentally realign its sales strategy to match what cautious enterprise customers are actually willing to spend their money on right now.
So, the required path forward for this legacy tech giant to regain its footing really looks like a two-step process. Step 1 is defensive. Improve operational execution to stop the bleeding and lock down existing client pipelines. Step 2, though, is strictly offensive. Capitalize on AI-related growth. To truly compete, IBM's watsonx enterprise AI strategy has to go head-to-head with cloud behemoths like Microsoft Azure and Google Cloud. You know, you can't just play defense in this market. You have to show investors that you're a dominant force in the next frontier of enterprise technology.
Which brings us to our seventh and final fact. Future earnings and AI-related growth will be closely watched. Look, artificial intelligence isn't just a buzzword for IBM. It is the absolute critical catalyst that Wall Street is demanding. Analysts are heavily scrutinizing whether IBM's hybrid cloud computing strategy and its AI synergy can actually translate into booked, undeniable revenue, rather than just, corporate hype. Investors need hard proof that IBM can capture massive AI market share while successfully navigating its current operational hurdles.
Finally, Part 4. Is IBM a buy now?
Okay, so here is the unfiltered reality of IBM's current market status. 1. Earnings missed the mark. 2. Revenue disappointed. 3. Customer spending unexpectedly shifted toward hardware. And 4. Major lucrative deals were delayed. 5. As a result, investor confidence weakened, sending shares lower. Looking ahead to 6, leadership is locked into an intense execution focus. And 7, all eyes are on the AI growth watch. These 7 factors perfectly encapsulate the immense pressure on IBM right now, and every major financial institution is utilizing this exact checklist to determine the company's true valuation.
We've laid out the facts, the executive missteps, and the high-stakes hybrid cloud and AI strategy. Now the verdict is yours. Is this steep drop a permanent red flag for a legacy giant, or is it the ultimate value buy of the year? Do you believe IBM can recover and actually win in this fiercely competitive AI era? Let us know your analysis in the comments below. And hey, if you want more no-nonsense, facts-first business, technology, and stock market analysis, make sure you subscribe to this Explainer series. See you next time.